Good afternoon, everyone, and thank you for joining us this afternoon. My name is Vito Dintrono. I'm Yarra Capital Management's Chief Commercial Officer, and I'm pleased to welcome you today to our webinar with Roy Keenan, our Head of Australian Fixed Income. Today marks the fifth in a series of weekly updates from our team, and these webinars really form part of our commitment to keeping you connected with our team and their insights as we work our way through the COVID-19 pandemic. In a moment, Roy's going to provide an update on the firm's thinking around the COVID-19 pandemic, detailing in particular how the firm's thinking about bank hybrids, but also providing a broader market outlook with regards to the Australian credit market. Roy's going to present for 25 to 30 minutes or so. We'll spend roughly 10 minutes on Q&A before wrapping up a little after, or a little before I should say, 3:40. Before I get started, just a couple of housekeeping items just to ensure we're all on the same page. The first of those, you're most likely listening to this webinar using your computer's speaker system by default, but if you prefer joining us over the phone, just select telephone in the audio pane and the dial-in information will be displayed. And secondly, all participants are in listen-only mode, but importantly, you can ask questions or submit questions at any time during this discussion just by typing the questions into the question pane. And we'll look to address those questions at the end of Roy's presentation during the Q&A session. With that, I'd like to hand over to Roy. Thank you, Roy.
Thank you, Vito. It's a pleasure to have everyone on the call today. One thing I would say is starting off with an observation. Been in the markets for a very, very long time, and what we've experienced over the last 2 months is a whole new experience for me. Not just from working at home and operating a fixed income team from home, but the sheer speed, the volatility in the sell-off that we experienced was something that we've never seen and was quite different in some ways to the global financial crisis. But also, in some ways, a lot of the same sort of themes have been repeating across, in our observations. The one thing I would say is, looking back in hindsight, which is always sometimes a terrible thing to do, but I think the majority of people definitely underestimated COVID-19. When we first started hearing the news, thinking about the impacts on markets, it's fair to say I think we underestimated the volatility in equities, credit, and in bonds. And I think the sheer speed of the move is what has caught a lot of people out, especially if you're positioned on the wrong side of the markets coming into this. The one thing I would say, is that some of the reactions we've seen from central banks, I think they in some ways need to be applauded. My time in financial markets, I've never seen a 10-year bond contract trade 180 odd basis points in a day. It's a pretty scary sort of environment. The liquidity premium in the marketplace was running at around 4 to 5%. Anyone who was following the Macquarie HBs could see you could buy them at $96 and get $100 back in essentially a month's time, which we were seeing similar sorts of stories, not just in the ASX listed, but in the over-the-counter market, where people trying to get liquidity were quite prepared to pay up to actually get that liquidity. So I think central banks have done well. They stepped in at the right time. They needed to reduce volatility and confidence in the markets. So I think that's been a pretty good outcome. But if we refer to the chart on page 3, you can see that the ASX listed hybrid market, once again, which is similar to the GFC, experienced a very rapid and significant sell-off, at one point being down around just over 15%. Similarly, EIF was down around the sort of 7% mark over that period. And in some ways that reflects more the position that we had going in that fund, which I'll talk a little bit later, which cushioned some of that sell-off. But you can also see the orange line there, which is the Bloomberg investment grade index. It's actually suspiciously, actually delivered very limited losses during that period. And I'll highlight this a little bit over the next couple of slides. one of the reasons why the Enhanced Income Fund did pretty well was, we had very much a bias leading into this sell-off of being in Tier 2 versus Tier 1. And I'll display this a little bit later as well. But we also had a preference of being in shorter dated credit securities rather than being invested for the longer term coming in, because we felt credit spreads were a little bit tight at that stage coming into the market sell-off. If we turn to page 4, and if we quickly just observe, and it really did feel like, in some ways, if we reflect on the Australian performance and what we saw out of what we've seen happen in global markets, we can see that global high yield has been extremely volatile. And also, if you look at the Enhanced Income Fund, we can see that the spread has just sort of gradually moved out across the time frame, which is pretty much in line with the US BBB Moody's index that we track. There's definitely been a divergence between the fund and what we've seen in the recovery in that US investment grade. But you can see on the bottom line there, once again, I'll refer to that Bloomberg Australian investment grade index. It hasn't really displayed a lot of volatility. And in some ways, I think this is explainable because, once again, the experience that we've seen through the global financial crisis has been that the over-the-counter markets have displayed pretty much the same tendencies during the global financial crisis. As volatility increased, risk-taking really did diminish. And what we saw was that pricing for secondary market investment-grade bonds, corporate bonds, actually did start to vanish from the screens, and once again also hard to actually establish where things were trading. The market was still open, it wasn't closed, but it definitely was very, very hard to actually identify where prices were. And in some ways, that's why I think that index was a lot more volatile, which I'll show in a couple of slides in a moment. Secondly, the one thing to note, I think the Fed, maybe one of the reasons why Australia, post the sell-off in the middle of March has not performed as well as the US has been obviously the Fed's support for not only the junk bond market, but the investment grade market in the US, whereas the RBA has sort of not gone to that sort of depth to support the corporate bond market. The other thing that is, it's quite interesting is that, it's a dilemma for all managers, especially have a fair bit of cash to invest at this time frame. One of the other reasons for that divergence that we've seen in the last 5 or 6 weeks could also be the fear of investing your cash at the moment at a time when we know that many individual Australians out there actually have the ability to pull $10,000 out of their super fund. So maybe the totality of the sheer size of that weight of money potentially coming out of credit, equities, government bonds is still weighing on investors, risk appetite to actually hop into the Australian market. If we turn to page 5 and we look at the investment grade bonds, and these are actually some data I've put out of Bloomberg for 2 credits that we follow, Incitec Pivot and GBT senior bonds. And one of the things I would mention in following this marketplace was that, and some of my concerns that I have for some of the pricing that we actually see during during this crisis, which in some ways is exactly what we experienced in the global financial crisis, is that where credits were actually trading is not reflected in the pricing. And to give you the example of Incitec Pivot, which is representing the dark blue line there, you can see their credit spread has just gradually widened over time to around 350 basis points. Yet I could say that from our perspective, we actually traded the bond at about 487 basis points in the middle of March. So once again, the market was definitely trading, but the pricing not reflecting the activity. Similarly to the GPT bonds, we have the price there, and as you can see, the low is 92 cents in the dollar. But we can actually say that we saw that bond trading very much in the low 80s, especially during that middle part of March. So why is this important? I think one of the things that we experienced during the GFC was that funds that had a high exposure to investment grade bonds essentially don't reflect the volatility in their performance over these volatile times. And I think over time you see pricing catch up and performance starting to reflect it. But I think when you compare the hybrid market on the ASX, where visibility, you get instant performance updates from the visibility of the ASX listed market, I think that will express the true volatility that we're seeing in the market versus what we're seeing in corporate bonds. From my perspective, we saw some amazing opportunities in the corporate bond market over that period. Companies like NextDC, which probably going into this crisis, were trading at around 400 over. We traded them at something like around 1,000 basis points over. So we saw them as very solid credits who are beneficiaries of COVID-19 with their IT in the cloud technology, and essentially we felt that these opportunities for those who had liquidity had to be taken at that point in time. If we move on to the ASX listed hybrids, and as I said, no doubt having things listed on the stock exchange gives volatility, it gives you liquidity, and the ability to actually actively trade the securities in the marketplace. And very similar to the global financial crisis, we saw credit spreads sell off to, in our view, some ridiculous levels. The sell-off was quite extreme. As you can see, the credit spreads on that chart on page 6 on the light blue line there, you can see that credit spreads were almost out to nearly 9 to 10% across the whole curve. This is the major bank credit curve. What was really interesting was the speed of recovery. And as you've seen over the last 6 weeks, we've seen credit spreads come back in towards the 500 basis points for major bank credit, tier 1 credit, and we think that is in some ways still quite outstanding value. The one thing that I would point out also, when you see a market down 15.9% on the 23rd of March and recovers to only be down 6.4% in March, it sort of half says that there might have been more than just a credit event. It was very much a liquidity event. And we half suspect that with the over-the-counter markets, somewhat limited liquidity taking place, if there was redemptions being seen in the marketplace, that one of the activities that would have taken place was people would have head to the ASX market. And we sort of half suspect that was that's exactly the experience that we saw during the global financial crisis, and those with liquidity were able to take advantage of that. The market has been quite strong in April. It'll probably close the month closer towards up 3% in April, which is, I think a solid outcome. But we are still seeing many opportunities presenting. If we turn to page 7, and you can see that the sell-off was not only constrained to tier 1 in major bank credit. You can see that in the middle on the chart there that, and this is represented by the NAB tier 2 2024 call securities with the call in 2024. They essentially were selling off. From I would say about 160 basis points being their low, close to getting up towards 380 to 390 basis points. But you can see the the steepness of that sell-off in comparison to what we saw in that tier 1 market. sort of probably ratifies that we think there was more of a liquidity event in the ASX listed market versus what we were seeing in the over-the-counter market. But we have no doubt that from a value perspective, that that as essentially, tier 1 and tier 2 securities for the banks, for those who actually were accessed at those sort of levels, will turn out to be, some very good investments to be made. If we just quickly turn to page 8, and one of the reasons why we do like major bank credit at the moment is that, the balance sheet for the Australian banks is in great shape. I sometimes don't like looking at these charts because the one thing it does highlight, if you compare the bank's tier 1 capital, where it is today compared to where it was in sort of 2008, 9, 10, you can see that, the banks have significantly higher levels of capital, and their actual assets that they invest in, or their loans, their risk-weighted assets they actually are taking a lot less risk than what they did back in 2010. So from a hybrids investor's perspective, you're getting compensated by significant spreads when balance sheets are at their best. So it sort of makes me feel that when we were investing back in 2010, 2008, we were probably pretty bad investors in comparison to where we were, the sort of value that we're getting today in major bank credit. The other thing I would point out is that from a perspective of the marketplace, and we saw this during the sell-off, was that there's a lot of rumours about major banks converting their equity, converting their hybrids to equity, and extension risk that potentially will fall out from that. And we saw that during the global financial crisis as well. We think the market overestimates extension and conversion risk, but we also think that over time, as we look to actually move forward with the convertibility of the hybrids, we don't think that we think that value will actually almost certainly come in to reflect that limited risk of that extension. I think Australian hybrids have some of the best rules to protect investors with their maximum conversion numbers, but I think also one of the great things that we tend to underestimate is a bank's ability to actually repair their balance sheet. So how cheap are Australian hybrids? And if we turn to page 9 and we look at how we think about value in the marketplace, and I think probably the most important thing to think about is our rule of thumb, and our rule of thumb is generally we like to think that from a valuation perspective, we want to be compensated think about the senior spread. We want to be invested in tier 2. We want to be sort of compensated about 2 times the senior spread, and if we want to invest in tier 1, we want to be compensated around 4 times the senior spread. So if we sort of convert that to a ratio of tier 1 to tier 2, to move from tier 2 to tier 1, you generally want to be compensated 2 times. Historically, if you look over this and took this chart back, some 10 years, that has generally been the rule of thumb. That's generally where those spreads relative to senior trade. But as you can see over the last sort of 12 months here, the spread between both tier 1 and tier 2 versus senior has been significantly very volatile. And it's not just happened during COVID-19. Back in the sort of third quarter of 2019, tier 2 became cheap relative to senior and tier 1 on the back of the extraordinary amount of issuance that was going to be undertaken for the banks to comply with the new regulations from APRA. And we sort of felt that the market back then was totally underestimating that supply, and we felt you were being compensated for that supply coming to the market. So from the perspective of our fund, we switched out of Tier 1 securities into Tier 2. And we felt that, relative to senior, being compensated 3 times the senior was quite cheap. And you can see over time that actually has paid off for the fund with that, Tier 2 to senior ratio rallying quite strongly. But what we've seen during COVID-19 is that volatility to senior has become extraordinarily, provided some extraordinary opportunities. And there's been times during this period where we've actually felt that Tier 1 was the cheapest to senior. And then there's been periods over the last sort of 4 to 5 weeks where we feel Tier 2 to senior has been a little bit cheaper than buying Tier 1. So how cheap are they today? Based off where we see senior at 77 basis points, we think sort of Tier 2 is about 130 odd basis points cheap, and Tier 1 at about 150 basis points. So we think it's really good entry levels compared to senior, and once again is compensating you for that sort of extension and convertibility risk that we think is being totally overestimated by the market. So why do we like banks? And I think ultimately for all the credits we invest in across the market in Australia, there's no doubt banks have the best ability to repair their balance sheet in a very short period of time, and they can do that in a number of ways. And NAB's a really good example. They've raised $3.5 billion in the last week or so, and they've also cut their dividend. But if you sort of dig a little bit deeper, you can see that the chart on the bottom of page 10, that the DRP underwrite that they undertook back in March, where they actually got a third party to actually help convert the hybrid that was maturing, the NAB PCs. And that added, plus the underwriting of their dividend, actually added about 35 basis points to Tier 1. Now, the recent capital raising has added around 81 basis points. So you can see that in a very short period of time, NAB has been able to take their CET1 ratio back up to 11.2%, which is a very strong position. Were we surprised that they were going to raise capital? Not at all. We saw that NAB really did have a really big refinancing task in 2020 for their Tier 1 hybrids. Not only did they have the NAB PCs having a call date in the early part of 2020, but they also had the actual NAB PBs coming up in December 20 as well. And if you think about what took place in March, where APRA allowed NAB and both Macquarie Bank to actually call off their hybrid raises, that took away about 1.3 billion of new money coming to the market for NAB. Not only do they have that conversion later in the year, but they also have the amortisation of their NAB HAs taking place, which on our estimates is around $600 million a year. So you can see that all up, they're going to have about $3 billion of Tier 1 hybrids that are contributing to Tier 1 capital rolling off this year. So that is a significant number, and that's why we're not surprised that the bank has actually reverted to raising CET1 capital via common equity. From a perspective of hybrid capital, and if we look at hybrid capital, you can see that the trigger ratio for hybrids to be converted is 5.12, which is significantly below the 11.2 where NAB sits today. I had some people call me during the major sell-off in March saying, is there a risk that hybrids could be converted to capital? And the answer is pretty much no. A lot needs to happen between now and that trigger taking place, I think we all would suffer severe real estate property losses if that was to occur. Just turning to page 11, and we're thinking about the future, how we're investing in the market today. And I stole a couple of slides here from Tim Toohey, our chief strategist, and a couple of things that I think really do cloud the picture at the moment is how do we actually think about credits going forward, and how's the government's interaction with how they've stepped into the marketplace today to support the consumer. And you can see on page 11 that the amount of stimulus, they probably have to be, given credit. They have actually acted pretty quickly. They've stimulated the economy. They've made sure household incomes have actually stood up very well. Maybe some of the cash is taking a little bit longer to get through to people, but ultimately, the next sort of 6 to 9 months, we feel the consumer is going to come out of 2020 in very good shape. The problem will be at some point, and if we turn to page 12, is we reflect on what happens when that stimulus gets removed. And I think that's the biggest decision we have as investors today is what's the economy going to look like post the government removing some of this stimulus. And you can see in Tim's forecast here, he has household income dropping quite significantly in 2021, which, in our view, will guide some of the decisions of where we invest money today. If we quickly move to page 23, and I'll probably touch on a couple of things here, but the first thing I would touch on is, is APRA. I think APRA really does need to be given, credit where credit's due. If I look at how APRA's, handled this market over the last, sort of 6 to 8 weeks in comparison to their counterparts in New Zealand, I think APRA has, handled the whole situation very responsibly. They allowed the cancellation of the NAB and Macquarie deal. I think they handled the refinancing of Challenger, their hybrid CGFPAs very well. I think allowing that deal to be refinanced in the future when when Challenger choose to is a pretty wise decision by the regulator. Although reading the PDS, I find it hard to believe how they're allowed to do it, but I think the regulator has done the right thing there. I think the other thing, by also notifying the banks of their decision on ordinary dividends, probably didn't need to be done publicly, but I think the actual guidance that they've given the banks is very prudent. And as we're seeing today, ANZ have deferred their decision to actually pay a dividend on their ordinary share. And I think that all these things, when we think about from a credit perspective, is all positive credit. Things that are negative from an equity point of view obviously impacts equity prices, but from our perspective as a credit investor, it's a massive positive. But how do we think about the future? And in 2000, we're looking ahead from today to where we will be in 21, 22. We really do think the consumer is going to come out of it really well. The only problem will be in 2021 and 22. And I think the biggest decision that we look at will be what are the structural changes that COVID-19 is going to make. And I've listed a few things on page 13 there, which, in my mind is probably the hardest thing to get your head around on when you're investing in some of these credits today. What are these companies and, more importantly, their sectors going to look like? And I think the obvious one is office. So investing into property and in office space in particular. If we think about ourselves and our own business and where we've always thought about housing 100% of our staff in the office today, I think this big leap that we've made across all our businesses to actually work from home will actually make businesses decide, do we need to actually have offices that house 100% of our staff? And I think at a time when supply is coming onto the marketplace, that's one sector where we think that there may be issues. There's no doubt that retail REITs, where we have very limited exposure at the moment, well, I think that model, in a sense, is some ways broken, and maybe the rent model within REITs will be more reflective of sales, more so than the typical CPI adjusted that we've seen in the past. What does housing construction look like with immigration, in a sense, being turned off? There's no doubt we're going to be building. We don't have a need to build 40 or 50,000 houses with immigration and our population growth slowing. And I have no doubt, if I look at my own behaviour today, post COVID-19, doesn't matter if it's eating habits, savings, there's going to be a whole generation of people out there who've never experienced the shock. And I think that some of the things that we actually look at in the future from a consumer perspective and their willingness to take on debt, maybe their thoughts of having money for a rainy day, the whole attitude, that bulletproofness will be tested. And I'm not quite sure if we're going to come out of this the other side. Ultimately, it will depend on the duration of how long this lockdown lasts. But I think the longer it goes, the more it has a chance of changing behaviour. I know from our position where we entered into this period in a pretty good shape from a cash position. I think the hardest thing that we've found is trying to understand whether we're going to see some selling in equity credit markets off the back of the amount of people registering to take out. I think we're over 1 million people today registering to take out their $10,000, and not to mention what's going to happen post 1 July. So far, it seems pretty smooth, but I'm always concerned when we start to see quite strong selling coming from the marketplace. The other thing that I would point out just quickly is that some of the things that we've been thinking about from our perspective is, because liquidity is at a premium, you sort of don't want to waste your cash or liquidity that you currently have by investing too short term. If you have a positive view on credit, you should be investing as long as possible to maximise returns and ultimately the capital price appreciation that you experience. With that, I could probably turn to page 14, and I don't think there's one presentation I can sort of go past these days without mentioning NABHAs. But just finishing on NABHAs, for those that know me, I know how I've been preaching about these securities since 2013 when the transition rules from Basel II to Basel III occurred. My confidence on these securities being redeemed has never been higher. With Macquarie calling their security back in January and paying out in April, I'm convinced that these securities don't qualify. But probably one of the greatest mysteries of this sell-off in COVID-19 was how much the market was prepared to sell down securities like NABHAs, and Crown HB, some of the corporates out there. To me, they made they provided tremendous buying opportunities. And as you can see from the returns there, for securities that are not converted to equity and essentially are traditional fixed income, I think they're a bit of a no-brainer for the fund. And with that, I'll hand back to Vito.
Many thanks, Roy. We might spend our remaining time just answering some questions. A big thank you for those that have submitted questions. For those that haven't, there's still plenty of time by submitting the questions through the question pane. So I look forward to receiving them. Roy, we might kick off with one bit of a long question. It goes, during the GFC, one comment Roy made has stayed with me. And that comment was, Roy, credit markets are telling us something that equity markets are not. Are we in a similar situation this time round? Equity markets seem to be at such a disconnect to economic data. A credit market is different. Or does none of that matter because of the actions of central banks?
Yeah, it's a very good question. Look, I think the one thing that the GFC is different than today was that the credit markets were warning equity markets for a long period of time before equity markets started to sell off. This has been, I think, both from an equity market and a bond market perspective, The sell-off was in tandem, same sort of speed. And I think when we look at the recovery coming out the other side, and I know Tim Toohey has a V-shaped recovery because he thinks the duration of lockdown is very short. Some people are very bearish on and don't have a U-shaped recovery because they believe the duration of lockdown is going to be much longer and therefore the economic impact much severe. I think the one thing that we need to think about when we look at the valuation is, is your entry point into this. And if I look at Australian equities today in comparison to the US equities, Australia's underperforming by about 9 or 10% since the start of the year. So Australian equities for me, probably in some ways are probably reflecting, are reflecting the probably truer outcome for the economy. Whereas if I look at US equities at the moment, I think I really find it hard to actually justify their valuations over there. So I think the whole market seems to be a little bit out of whack from that perspective. But there's no doubt trying to pick how the economy is going to look post-COVID-19 is the toughest thing. For those who do pick the winners quite well, are going to be handsomely rewarded. And that's what we're trying to do.
Right, I might just kind of whip through a couple of others, Roy. The next question, on banks, do you have any concerns relating to impaired loans increasing from both residential or commercial loans?
Yeah, it's a good question. We've seen some banks at the moment. If I look at it from my perspective and my fund's perspective, I'm not concerned because I really do believe the banks have the ability to repair their balance sheet really, really quickly with access to equity. And in the past, they've been so preemptive to do that. There's no doubt if you look at some of the numbers that Westpac have put out on their commercial property, that's where the biggest risks lie. I think there's some funds out there and some sectors of the market that, mezz debt who've been lending to developers that will suffer some significant losses because if you think about where the economy is going to be, what sort of shape it's going to be in, there's no doubt there has to be losses experienced in that sector of the marketplace. But if we bring it back to the major bank, I think they have the ability and have the capital strength there to absorb those shocks. If I was invested in some mezz debt funds that invest into those relevant sectors, I'd be pretty concerned at this point.
Great. I might just try and slot another question in, Roy. Are there any attractive opportunities outside of the banking sector that the team is assessing?
I have to say we've been a big advocate for Crown HBs. I know during the period they sold off into the low 80s, might even got into the 70s. We think their balance sheet, Crown Resorts, has been in great shape. Plenty of access to liquidity. Don't have a lot of fixed debt charges apart from a capex for the rebuild of Sydney. So we thought their actual credit standing reflective of where the hybrid was trading was just outstanding. But we've looked at them. As I said, in the investment grade market, we've been buying Intertech Pivot. We feel it's going to be a great season. We've looked at New Farm a bit because obviously rain and agriculture should do very well. If anyone only has to look out the window in Melbourne, if you're based there, how much rain we've been having right across the state, and we feel that especially agriculture is going to do very well out of over this coming cropping season. So we've sort of been trying to focus on the sectors that have not been impacted as much by COVID-19. There's no doubt there's some sectors it's really hard to get a clear picture of what the outlook's going to look like in 12 to 18 months' time.
Great, thanks, Roy. We've just ticked over 3:40, so we might just finish up there. I guess on behalf of myself and Roy and the entire team at Yarra Capital, a massive thank you for joining us today and for your ongoing support. Greatly appreciated. If there's any question following today, in the first instance, please contact myself, Nick Green, or Ramal Hakopian. and we'll be more than happy to help you out, or if not, arrange a follow-up meeting with the various team members to discuss your question. A couple of things to look out post today. Firstly, an invitation to our next webinar, same time next week. More news to come shortly. And we'll also receive a survey just after today. Any feedback greatly appreciated as always. That's it for today. A massive thank you once again, and enjoy the remainder of your afternoon. Thank you. Bye-bye.